Good evening, everyone, and thank you for joining us for our virtual homebuyer seminar. My name is Barbara Agan, and I am the Director of Member Engagement and Education with ABCO Federal Credit Union. Our presenters today are Patrick Wade, an account executive with Member First Mortgage, and Bonnie LaRich, a preferred realtor with RE/MAX. I will now turn the meeting over to Patrick.
Awesome. Thanks, Barbara. So prior to getting started here, Bonnie, if you could introduce yourself, give your work history and fun fact about yourself, that'd be fantastic.
You got it. My name is Bonnie LaRich. I'm with RE/MAX Preferred in Sewell, New Jersey, but I do work 5 counties: Burlington, Camden, Gloucester, Salem, and Cumberland. And I've been in real estate 32 years, so anything you need to know, I know it.
Awesome. What's your fun fact, Bonnie?
Fun fact would be that I'm a vegetarian. How about that?
Okay. Nice. Great. So my name's Patrick Wade. Barbara, thank you so much for the introduction. I work for Member First Mortgage, which is a CUSO, a credit union service organization. It's a company that only works with credit unions to help credit unions provide first mortgage services at lower costs, lower fees, and more efficiently. My background has always been in mortgages. I've been in the mortgage industry since 2001, so 19 years since I graduated from Georgetown. One of my favorite things to do in the world is talk about mortgage financing. My wife thinks I'm absolutely insane, but I can talk about financing 24/7. I find it absolutely fascinating.
I can relate to that.
It's fascinating to me. As a mortgage professional, over 19 years at this point, I've worked with thousands of first-time home buyers all over the country, and each person's scenario is a little different. And so you're on the call tonight, you're likely already a member of the credit union. I can definitively say that as a member of a credit union, you have a distinct advantage in your mortgage financing. As an employee of a CUSO, I get to work with all credit unions. But in my past, I did work with mortgage banks, mortgage brokers, correspondent lenders, and I can definitively tell you that your credit union, specifically ABCO, has a tremendous amount of mortgage experience, not only on staff, but the CEO, in fact, is what I would consider a mortgage expert. And so they take their program very seriously and are able to offer you, the member, not only every type of program that's available in the general market today, but they put together portfolio loans, meaning loans customized to you, the member, which you can't get outside of this credit union. In working in the CUSO world, I work with over 200 credit unions, and I can tell you that ABCO Federal Credit Union, stands, head and shoulders above not only your traditional lenders, but most of your credit unions nationwide. They design programs around you. I know of no other program that takes their membership and their offering to that level. And what that means for you is it's a huge advantage, not only in reduced rates and fees, but in terms of access to financing. And I'll ask Bonnie to comment. Bonnie, in your 30-year career in real estate, how many times did you have a potential buyer, not be able to move forward as quickly as you would like because they didn't have access to customized financing?
That's so very true. And frankly, in the past, the credit unions didn't have all of this like ABCO does. ABCO is extremely unique, and they have a program for everyone. And that's what's really, really amazing about it. It really is. And I would say over 77% of people that bought homes in 2018 were under 20% down. So you don't even have to have that full 20% down.
Correct. And we'll talk about that more. I'm also a stats man. I love statistics, and I can tell you in the credit union world, the average percentage down is, less than 5%. So it's, we're going to come up with a strategy tonight customized to each of you so that you're able to leave tonight with a better understanding of what you need to do to prepare and, you know, the overall fundamentals of applying for a home loan. I think a lot of people think you just plop your information online and you hope, you cross your fingers. That's not really a plan. So tonight's going to be very informal. We're initially going to go over some terms so that you can understand some of the documents you're going to see and the terminology that's going to be used as you navigate through the home buying process. One of the main things I want you to leave from tonight is how to prepare. So we're going to talk a lot about budgeting and how to plan for buying a house. You know, in 20 years of doing seminars, which is, I told you, is one of my favorite things to do, one of the best compliments that I've ever been given after a seminar is I had a woman come up to me afterward and say, I don't want to buy a house right now. I took it as a great compliment. A lot of people might take it the wrong way, but I took it as a compliment because we gave her enough information and empowered her, right?
That's so true.
When you give somebody information, you empower them. You take away that fear, because the fear is largely generated from the unknown. And so when she left our seminar, she said, I don't want to buy a house right now. That gave me a lot of confidence that I gave her the right information, because she left that seminar knowing that she wasn't ready yet. But she also left knowing what she had to do, right? So you're going to take some action items from tonight. So
that gives them an advantage.
Gives you a huge advantage, because the emotions that you're going to feel throughout this process are really twofold. Many people are going to be really excited. They can be dangerous. If you're overly excited in buying a home right now, you have to take a step back, right? Because you have to put things in order. We want you to be excited. It's a great experience. Home ownership, path to wealth, but there are steps involved. If you're overly fearful, what you'll end up doing is nothing. You won't move forward, right?
It'll be a deterrent.
It'll be a deterrent. You'll be afraid to move forward. So we want to find that middle ground. The best way for us to help you find that middle ground of those emotions is to educate you and give you a plan.
Give you all the tools you need.
All the tools you need. So we're going to talk about some terms initially. We're going to walk through the process of preparing for your application, because there are some steps you need to take. And then we're going to go over any questions you may have. Good. So we'll take a look at some of the slides now. We'll move through the terms pretty quickly, but we want to give you a comfort level of some of the terms that are going to be used as you move throughout the mortgage application. So one of the only out-of-pocket expenses that you're going to encounter as you go to buy a house is an appraisal. An appraisal looks at the property you're buying, compares it to 3 like properties of size and distance from each other. Typically, the cost of an appraisal is anywhere from $350 to $550, depending on the type of property. The lender does choose the appraisal, the buyer does not. You're going to hear the term APR. So many times when you start to apply for financing, you'll apply in 3 places, and that's okay. How do you compare which loan is best for you? Well, that's really why the APR exists. The APR creates a baseline so that you can compare loan term to loan term and cost of those terms to each other. It normalizes it. So for example, if you had an interest rate of 3% and fees of $10,000, would that be a better or worse loan than a loan that had an interest rate of 3.125% but fees of $3,000? I can tell you the APR would be lower on the interest rate that had a higher interest rate but lower fees. And so that would actually be the better loan for you. You always want to choose lower APR. Closing, that's where we're all going to get to once we go through the process. Closing can be a very difficult process for a lot of people, because what they do is they'll get to closing, but they haven't read any of their documentation, and now they're signing 30, 40, 50 pages, and those 30 or 40, 50 pages outline that they're going to be making payments for the next 30 years. And so the number one thing that I can recommend to you throughout this process, because it's a process, it's not a transaction. So transactions like you're hungry, you want some food, you go, you buy a candy bar, here's my $3, you get your Snickers and you eat it. That's a transaction. This is not a transaction. This is a process.
Right.
Can
I interject there?
And during that process, you're going to feel those range of emotions. But what you can do in that process is you can take control of it. And when you take control of the process, you're going to feel a lot better about it. And the end of the process isn't really closing, but that's the formal part. But
Right.
at closing,
Can I interject in there, Patrick?
Sure.
I didn't mean to cut you off there. It's absolutely true about that. It's a process, not an event. And as I always say, it takes 22 people to get the house to settlement. And I coordinate all those people on behalf of the buyer, of whom I have a fiduciary, meaning that I do what's in their best interest above my own for them.
That's absolutely true and correct. And Bonnie, I can tell you of those 22, there could be 24, 25 people. The person that you're going to likely to spend the most amount of time with is your real estate agent. So you want to make sure that you choose, you choose one that you can work with, because you're going to, on average, Bonnie, how much time do you spend with a potential homeowner?
Well, for buying, it varies on their experience level. If they're a first time or second or third time buyer or more, I'll spend as long as necessary. I'm a very, very patient person, and I don't pressure anybody. I just want to make sure they understand and make a good decision, because it's one of the biggest decisions you make in your lifetime. And it's the single most important investment decision of your lifetime.
Good.
So you have to take all the time necessary.
Good answer. And to feel comfortable throughout the process, especially at closing, what we want you to do is read your documentation. You're going to receive documentation, 3 times throughout this process. And though it is effectively the same documentation, most people don't read it.
Right.
And what happens is they go to settlement to sign it for the final time, and they're nervous. I've seen it many times. It's kind of like one of those things where, like, it sounds like a great idea and it will work, but if you don't do it, it doesn't matter. So what I want you to do is, when we send you documentation, I want you to read it. We'll narrow it down for you in terms of the importance of certain documents. So for example, your loan estimate and your closing disclosure are likely the most important documents in your package, but you're still signing another 50 pages of disclosures. So we want you to read that. Now, to kind of break it down for you in a timeline, your process can take anywhere from 30, 60, 90 days. From the time you find a house to the time you get keys. And so if we're giving you, say, 50 pages to read, realistically, you can read 1 page a day. And it's going to help you, because now you're removing what? What do you remove? You're removing the unknown. And so that's going to make for a more pleasant settlement, more successful settlement. But more importantly, it empowers you, because you've now given yourself information to where you can make decisions. And that's a lot of what goes into home ownership, is that preparation. You can think of reading as preparation. Now, the number one thing that first-time home buyers, or home buyers in general, the number one thing that prevents them from becoming an actual home buyer is what? It's the cost, the overall cost of the transaction. I don't just mean the closing cost, okay? Closing costs are gonna vary based on your transaction, and I can tell you definitively, over 20 years, credit unions have the lowest closing costs going, especially APCO. But the number one thing that's going to impede you from being a potential homeowner and prevent you from becoming a homeowner are the overall cost of this process, this transaction, which means your down payment, your closing cost, and setting up an escrow account. That's an account to pay for your taxes and insurance when they come due. And so we're going to go over strategies tonight, which start with creating a budget so that you can plan for those 3 costs that are involved. You can get there. It might just mean once you sit down and do your budget and put your plan in place, you might have to make adjustments. And the last person I spoke with last week that was in the prior seminar, we literally sat down in a go-to meeting and I showed her how I put together a budget in my house, which is I set up an Excel spreadsheet, put down columns. And by the way, it's really uncomfortable to do.
It is.
And I can tell you this, when I do a live home buying seminar, I'll say, by a show of hands, raise your hand if you put together a budget. And I can tell you without fail, in 20 years doing this, when there is more than one party in that household, and you see a couple sitting next to each other, one raises their hand and the other one looks at them and goes, "We do a budget?" But they don't even talk about it amongst themselves.
That's
because
so
talking,
true, Patrick. That's so
talking
true.
about your finances,
There's nothing like being
uncomfortable.
honest. So many people now know they may know like maybe one credit score, but they don't know all three.
Right.
You have to know these things, and you have to, a lot of people will try to buy a house at tax time because they get a little bit of money back, or they're not sure when they should start and they're renting and then their lease expires, they start again and again and again. You need to think ahead about these things, because every year that goes by, you're paying somebody else's mortgage.
Right. And what I'll tell you is there's really 3 P's to this: planning, right? Planning, preparation, and practice, right? So, for example, when you sit down and have that conversation and do that budget, it doesn't mean it's set in stone, right? It's malleable. So you're going to have to tweak it as you go throughout the process. And that might even be midstream, where you thought you were going to buy one house. For a variety of reasons, you switched gears and you're buying another house, and now the taxes and insurance are higher, and so you have to retool your budget. So this is an active participation process where it requires honesty with yourself, with those involved in your household.
You'll never succeed with finances unless you're honest about it.
And you're going to have tough conversations. So, for example, when I do my personal budget, I can tell you right now, not only does it outline where we spend money, but it outlines habits. So, for example, I have some bad habits. One of my bad habits is I'm a shoe man.
We all do.
I buy shoes. I like shoes. Not going to change whether I have a house or I'm renting. So I better plan for it before I buy a house. And what you'll learn is, through self-discipline, through choices, who's in control of this process? You.
Yeah.
You're in control of the process, not the lender. Okay?
I remember Susie Orman saying, if you go to Starbucks every morning and you spend $3 on a coffee of some kind or more, times how many days of the month do you do that? That's a lot of money. By the time you figure that, you could be saving that money.
Right. And what that does, right?
Small change.
Little things like that add up.
They totally do. We don't realize how our money just seeps away.
And the reality is, what you're going to, when you do this budget process and you have this conversation, you start this planning, what it does is it's going to give you control of the process, because then you're able to determine the outcome. And that starts with things like this tonight, where you get information. We're going to ask you at the conclusion to do a budget, or to meet us online and do a budget with you, so that you have full control of the process. And what that will do is you will feel empowered. And that will make you feel much more comfortable about determining when and if you're ready to buy a home. Now, throughout this process, we're going to use some terms like DTI, debt to income ratio. Most lenders will look at a set of guidelines from the 2 largest lenders in the country, Fannie Mae and Freddie Mac, which ABCO has access to. But ABCO, given that they take a genuine interest in customizing their programs around their membership, they can look at a debt to income ratio as a guide, but not an end all. So, for example, they can look at you, the individual member, and say, okay, the debt to income ratio with Fannie Mae is XYZ, but because this member has compensating factors we have the ability to design a program that doesn't necessarily hinge on that number. What APCO is doing is they're taking the inconsideration out of lending. They're considering by looking at you individually, which is a tremendous advantage. I can tell you, if you go to a big bank and you don't fit the box, they'll send you a denial letter. That's it. That's not what your credit union does. And so what they do is they're going to design their program around you. It's a phenomenal position for myself to be in, because I get to then talk about that at home buying seminars and deliver a message of empowerment. I love doing it. Impounds. So most first-time home buyers are going to choose to pay their taxes and their insurance and their monthly mortgage payment. That was part of that escrow account that we talked about in terms of the money that you're going to need in order to go to settlement. We talked about, you're going to have down payment, closing costs, and an escrow account, which is your impounds. Now, you'll pay for those taxes and insurance monthly, and the lender will pay those bills when they come due, which is generally, quarterly or bi-quarterly. Loan estimate. Of the 45 to 50 pages that you are going to receive throughout this process, the number one page you're going to want to review is your loan estimate. It outlines all the details of your transaction, your overall closing cost, what it's going to take to set up your escrow account. And it's a great tool to take when you make your application, take your loan estimate, go back to your budget, and then plan so that you can look at, okay, here's how much I need to have set up for an escrow account. Here's how much I need for my down payment. Here's how much I need for my closing costs. And then you can break that down monthly and say, okay, for me to become a homeowner, here's what I need to change in my personal budget so that I can achieve that in X period of time. And so that's a great tool.
Plus, if you speak to a lender, and whether you're ready or not, that gives you the foundation of definitive goal in order to get to the point where you can start buying a home. Because you will then know exactly what to do.
Right. And so what we want you to do is take that information that we're going to give you and go back to that budget and see that if it's in line with where you are today. And if not, you don't throw your hands up and say, well, my budget's blown, I can't buy a house. You go back to the drawing board, right? You're going to continue to make small adjustments throughout this process, of which you're in control. So it's more information that you're going to pull from the process to go back and take power and say, okay, here's where I need to be. Here are my action items. Buying a home is a very active participation process. It's not one of those things where you kind of just sit back and go, okay, I'll wait for somebody to call me. But that's not setting yourself up to be a successful homeowner. On that note, I'd like to highlight that when you have your monthly mortgage payment, right? So you're going to take that into account in your budget. Though you're going to have a payment of principal, interest, taxes, and insurance, those are not your only monthly expenses to own a home. Simply not. And that's why the budget part of this process is so important. I've owned up to 15 houses at one time. Right now I own 3. I can tell you that each property is slightly different than the other ones. And I have to plan accordingly for things that not might come up, but things that will come up. The house is an active project. There will be things that you want to change, you elect to change, and there will be things that you have to change. So for example, a water heater might go, not something you can do without. So you want to, in your budget process, kind of create a capital account for when those things come due, because they will come due. And again, what that's going to allow you to do at the beginning, when you start that process, it can be a little daunting, a little scary, because you're like, oh, what am I getting into? But when you write it down on paper and create an action plan, it removes that fear of that unknown, which creates fear, and you replace that with information, which creates power. So it's all good things to do throughout this process. One of the things you're likely going to see is private mortgage insurance, which is generally put into place. If you don't put 20% down, that's okay. Private mortgage insurance can go away over time. Most people think that it is insurance that protects them. It's actually insurance that protects the lender. The borrower pays for it. Most people then groan when I'm in, live doing that. But the reality is private mortgage insurance is actually good for you, the borrower, because it allows the lender to make a loan they otherwise wouldn't because they're able to gain insurance.
It's a whole reason why you can go less than 20% down.
Now, there are options throughout the process where that private mortgage insurance could either be built into the interest rate, but your loan officer will be able to compare scenario to scenario and work with you to decide which path is best for you. So there's a lot of options, a lot of different programs. We're going to talk about those shortly, but that is something I like to highlight because when most people hear mortgage insurance, they think it's, protecting them.
Right. And if I can add to that about speaking to the lender, I know I said it already, but one of the points of honesty is when you speak to the lender, you'll really know what your credit is. Okay, there will be no questions. You'll be as clear can be, and the lender can help you to tell you what to do to improve it, really in real time, and offer the correct procedures and methods of getting to the point of buying the home.
Good. Now, we mentioned throughout the process, you're going to receive paperwork multiple times. And the reason behind that is after you've prepared to make application, you've put together your budget, you've put together the documents that you're going to need, which we're going to talk about shortly, and I call it the rule of two. You're eventually going to, after you make your application, you're going to see preliminary paperwork that has information that says, TBD, because we don't have a written sales agreement yet. After you receive your agreement of sale, your loan officer is going to update your paperwork with the information contained in the agreement of sale, which you're going to want to review again because things will change. You're likely, based on your pre-qualification or pre-approval letter, you're probably going to buy a property that could be higher or lower than that value, so some of your values are going to change. You don't want to start this process with a purchase agreement. I've seen that a number of times over the course of 20 years. The danger in that is if you haven't made preparations to make a mortgage application, haven't gotten a pre-approval, there could be things that you had to change and you might not be able to after you get the agreement of sale. I've seen it, not recently, but I've definitely seen that. So it's sort of the second part of the process. Title insurance, you will have title insurance. It's around $5 or $6 per thousand borrowed. It protects you as the buyer, as the purchaser, in the event that there were past liens or things on titles.
Over the ownership.
So it conveys a clean bill of ownership. The mortgage payment we've talked about, principal, interest, taxes, and insurance. Again, I don't want you to think of home ownership as that is your only cost. You're going to have utilities. You're going to have repairs. You're going to have things that you want to do. When you first buy a house, it's actually one of the more expensive times in your life, the first 3 to 6 months, I would say. And I would ask Bonnie to speak on that, in more depth. But any home I've ever purchased, I wanted to go in and change some things. And
right.
Bonnie,
for sure.
Maybe elaborate a little bit of what you see with your clients.
Everybody wants to paint. They want to personalize it. They want to do certain things to make the home feel like their home. And of course it's an adjustment when you have a mortgage payment, but it was an adjustment when you had your first rental payment too. So you're just taking another step, but this step is one of the most important ones you'll ever do in your life. And this will move you forward in your own financial planning, and it will get you on the road to better financial success.
And it all starts with that budgetary, planning, inclusive of everyone in the household. One of the first properties I ever bought was, a near disaster in my personal life because I didn't take the time to sit down with my then girlfriend, now wife, and put together a needs and wants list, or put together kind of a list or put together really a budget. And it was a big mistake. I was, a younger person, ready to buy a house yesterday and, looking at properties and thinking that I was the only person involved. And it was, pretty much, it was a selfish time in my life. And thankfully, senses got the better of me, and I was able to kind of sit down and discuss things and put it on paper. And it really calmed the process down and helped us make, the right decision. In fact, where I'm sitting right now is the house we ultimately decided to buy. And so, having that information and really kind of preparing, has allowed us to be successful homeowners. And that's what one of the things I hope you get from tonight is really that preparation. So we're going to take a look now at the overall mortgage process, which really is keyed in on in that preparation. So before we make an application, we want to think about, okay, how do we get there? So we've mentioned budget a number of times tonight. So a budget is something that is very simple to do, simple to use, and simple to avoid. So what I ask that you do tonight before you go online and make application or call ABCO and ask to speak with a loan officer is after we conclude, I want you to literally just take a pen and a piece of paper. Or if you're an Excel person like me, grab your laptop, grab your computer, and use Excel. But take a pen and a piece of paper and simply write down, with 2 columns. One column is, income, how much you have coming into the house. And what I ask you to do is look at income after taxes. Though in the mortgage world, okay, we're not so logical in the mortgage world, we look at income before taxes, which to me drives me crazy, right? Because I can't spend money that I sent to the government without me receiving it. Makes no sense to me, but that's how the mortgage industry works. But write down your income after taxes, all income coming into the property, and then write down your expenditures. And when you write down your expenditures, I want you to be conservative high. And this is part of the pre-qualification process. Be conservative high. So for example, if I know that I spend, $150 on sneakers every month, I do, add in, say, 20%. Just to be conservative high. You can back this out later, but this is just an exercise in, sometimes there are months where I spend a little more, sometimes a little less. But you have to have that honest conversation with yourself to know who you are. Because if you like to spend money now, that's not going to change when you buy a house. You're not all of a sudden going to become a saver. It's not how it works. In fact, you're going to spend a little more at the beginning because you're going to want stuff. You're going to say, you know what, that wall needs TV. Or you're going to say, I don't really like the color of this paint. I need pink. I need fuchsia. And that costs money. So you want to be able to create a budget based on some ever-changing needs. New homeowner, you're going to want to do stuff. And also understand that you're not going to all of a sudden become a saver. My sneaker habit hasn't subsided since I've owned a house. It's only increased because I have more closet space. It's true. We want to start with
size doesn't change.
Yeah, no, same size, 10.5. So, I'm 6'2". I should have a bigger foot. I don't know. That's what I got. Put that budget together. Be conservative high, and put the budget together with all those that are thinking about buying a house. Okay. Then what I want you to do is look at a few properties of where you're interested just on realtor.com, just to get an idea of, okay, for this amount of money, here's the type of property I can get. Again, this is all preliminary before you do anything because this is going to work back to that budget. And look at what the real estate taxes are going to be. Your homeowner's insurance is likely going to be somewhere between $100 and $200 a month. Take the middle ground. Again, this is the preliminary work for pre-qualification. So you can then get a visual picture of numbers. It makes the process a little more tangible, okay? And then I want you to think about the rule of 2, okay? Rule of 2. I do a lot of credit union trainings for staff, and a lot of times the staff doesn't initially have first mortgage experience, and so I want to keep it as simple as possible for them. So the program I use is called the Rule of 2. The Rule of 2 for a mortgage application and the Rule of 2 for mortgage documentation. And that rule of two is this: an application is going to involve a 2-year history of where you lived, where you worked, and how much you made. 2-year history of where you lived, worked, and how much you made. Okay, this is that preparation process. Documentation, we're going to need 2 pay stubs, 2 W-2s, 2 tax returns, 2 asset statements, 2 forms of identification. In the mortgage world, for some reason, we're fixated on the number 2. This is all, again, in that preparation. Well, we haven't even talked about an application yet, right? This is all preparation. So what that's going to do is that's going to give you that power to say, okay, I have my budget. I have an idea of what I'm going to spend. And by the way, after you have that written down, you might look at those numbers and go, I don't feel really comfortable there. That's okay. This is the time to feel uncomfortable before you've gotten a house under agreement, before you've made application. You know, one of the things that I've always found interesting is that honesty in this process and honesty in life will absolutely always make you the most successful. Because where we get into trouble in life as human beings is when we're not honest with ourselves. It's true. It is absolutely true. And where I'm going with that is, when in the past, when I was a loan officer or a mortgage broker, working directly with individual members to help them buy a house, I can tell you 9 times out of 10, some days 10 times out of 10, the person on the other end of the phone, or the person I was meeting with, would say to me, Patrick, what's the maximum amount I can borrow? What's the maximum amount you can get me approved for? People will say that to you today. It's our natural go-to as a human to say, what's the most I can get? How much can I get? It's true. Now, when I ask that question in a live home buying seminar in person, you'll see crickets around the room. No one ever admits to it. It's true. It's true. Come up to me after the seminar and say, hey, what do you think? Here's my situation. What's the maximum I can borrow? As a credit union staff member, and all the credit union staff members, we want you to be successful. We're going to redirect that thinking.
Right.
And redirect that in the form of this question. How much can you afford? And how much you can borrow? How much can you afford? One word difference, really, but very different propositions and very different outcomes. And where you get that information isn't from me. It's not from Bonnie. It's not from Barbara. It's from you in your preparation.
Right.
And when you write those numbers down in that budget in your preparation and prepare that and gather that documentation, you now have that information at your fingertips so that you can say, okay, wait a minute. Here's my number for principal, interest, taxes, and insurance. I don't like it there. I'm uncomfortable there. You have to either make an adjustment to the property you're buying, the amount you're spending, or in some of your expenditures.
Yeah,
But who's in control of that process?
Yeah, you are.
You are.
Yeah, I think that when I started in real estate in '88, I would find that people, if they could afford, if they first say, let's take first-time buyers, let's say they qualified for $250. Well, they qualified for $250, they wanted to buy more. Now they qualify for $250, they want to buy less. They're more comfortable. I find people are more frugal now. They want a more comfortable payment so they're not house poor.
Right, right. The key is to be informed and be honest with yourself, right?
Exactly.
And that's probably what they're doing, Bonnie, is right there sitting down saying, hey, I have an app that allows me to do a budget. I don't need a pen or piece of paper. I got an app right here. They're more informed. And so, you know, they're able to say, okay, here's where I want to be. Here's where I need to be. And that number is going to be different for everyone. For me, in order for our family to answer that question,
Of course,
my payment would have to be something that I didn't have to think about, meaning it didn't cause me to stay up at night.
right.
That's how I decided. Everyone's going to get there through a little different path, but the point is to make sure that you feel comfortable with that, with what you can afford, not what you can borrow. Because they're two very, very different values. Again, keep in mind what we said earlier. The mortgage industry is simply looking at your income before taxes. Raise your hand if you don't pay taxes.
Yeah, right.
Everybody does,
Right.
right? That's how we have roads. So that's how we have schools.
You're right about that. I never really thought about it, but it's
Yeah,
true.
take that into consider. It's real.
It is.
Imagine if they didn't take that money out, how much more money you'd have? A lot. So we want to follow that rule of two with preparation. We want to follow putting together a budget, right? This is really this is what I consider the pre-qualification process. That's before you make application, by the way. This is all that prep work. In reality, it'll take you maybe a half an hour. Half an hour preparation for a process that takes 30, 60, 90 days for an end result that might be 30 years. Do the 30 minutes, right? When you put it in that context, it makes a lot of sense. 30-minute preparation for a 60, 90-day process that lasts 30 years. Seems like it's something you could do. Now, when you're ready to make application, after you've done all that prep work, right? Prep, plan, process, you're going to make your application. Your loan, you can do that online. You can do it in person, over the phone, however you feel most comfortable. Your loan officer is going to reach out to you to have a conversation about the information that's contained in the application. They will get you a pre-approval letter, which you will use to go out and present to Bonnie so that you can start to begin to look at properties, which, by the way, is the most fun part of the process. I think financing is, but I know looking at houses is much more enjoyable. After your documentation's been received, right, they're going to ask you for documentation in that process. You're going to work with a processing department that's going to look at your documentation to make sure that all your documents are there. An underwriter will take all that information that you've sent in, and the underwriter simply verifies all that information to make it sure it's true and correct. Now, during this period of time, there are things that are happening at the same time. So you're looking at properties, you're eventually
having an inspection,
property inspections, looking, getting an agreement of sale, hoping to go, to settlement as quickly as possible or within that time frame. And then you're moving in. That's the process in a very condensed way. Very condensed way. We outline it a little more here. We want everyone to get pre-qualified, but really pre-approved. That's why I'm asking you to get that documentation, rule of two pay stubs, 2 W-2s, 2 tax returns, 2 asset statements, and 2 forms of identification. That will get you your pre-qualification, pre-approval letter. And that is when you will start to work with Bonnie. Bonnie's going to outline how she works with each individual member. Bonnie, could you elaborate?
I would really like to. This is a very important part because if you back up to the part that says look on, Trulia and Zillow and Realtor.com and so forth, this is one of the things I'd really like to make clear to everybody. There's no one who's a better asset for you than your real estate agent and your lender. And I will tell you that it's not true that Zillow updates their inventory like they claim they do. What we have in the MLS, we send to you the same day that the new listing comes out. And sometimes Zillow doesn't have that for 2 to 3 days. So you really need the agent to give you the inventory the first day on the market, particularly because in the market we have right now, which is really different than it's been in the past few years, you need to see that house right away if it meets your criteria, because there's not a lot of inventory. And I will also tell you that knowing, making the decision when to buy, most people think their lease is over the beginning of a month. Every lease I've ever seen is over at the end of a month. And if your lease is over at the end of a certain month, when do I start looking for a house? You should start looking for a house maybe 3 to 4 months before your lease is over, but you should talk to the lender before that so you can see what you need to do to get in a position to buy 3 to 4 months before your lease is up. so you can coordinate the purchase of your house with the end of your lease.
Bonnie, could you give an example? So I know from, my personal buying experience, one of the things that would have helped me with my first purchase was to put together a needs and wants list with my spouse. Could you
Absolutely.
elaborate on how you work with individual members
Sure.
throughout that process?
Want to emphasize that I tried to do that really after they speak to the lender, because we need to know how much they can afford, because that number may determine whether they can have 2 bedrooms, 3 bedrooms, or 4 bedrooms or more. It also determines whether they want a condo or a single family home or a townhouse or something in between. So first you need the qualification number and the number that you're comfortable with in payment. Then we can talk about how many bedrooms, bathrooms, how big your family is, how close to work and your property will be that you're looking for, or a good school system, and those types of issues.
Good. And definitely in that process, Bonnie, how often would you say, based on, putting that together, that list of things that, people wanted or needed, how often would you say that changes?
Well, I think that the basic part of it doesn't change a lot during the process, because, if you have 2 children, or if you have 1 child or no children, that's usually pretty definitive. But if you have 3 children and there's 2 parents, you definitely need 2 full baths in the house, that kind of thing. So those kind of things kind of stay the same. But right now we're seeing a lot of people looking at fixers as opposed to a ready to move in house. So I've seen that change a lot when that's the case. But of course, most first-time buyers cannot do fixers, as we know, because the financing, it must be in good condition to buy the house.
Now, Bonnie, this is more of a personal question from me, but I know I want to ask it because it's going to highlight something, I think, for the group here. And again, I told you I've owned, up to 15 properties at one time, some of them multi-unit.
Yeah, good.
But Bonnie, here's my question to you, and I'm being slightly facetious here, but it's to drive home a point.
That's fine.
In 30 years, how many perfect homes have you found?
Never.
The reason why I want to highlight that is you have to go into this process of buying a home with a very open mind. The reason being is there are no perfect people. There are no perfect properties.
Right.
In where I am right now, we redid our kitchen twice now. Most recent 3 years ago.
Good for you.
And I can tell you, for 11 years, I lived with a wall that the first day I bought the house, I spoke to the wall.
Right.
Said, I'm going to knock you down, wall. One day I'm going to knock you down. I don't have the money today, but you're coming down. Your days are numbered. Well, the wall had another 11 years.
Right. Well, one of the things is that, most of these people will be buying a resale home. So it's not new construction. So there's not too much perfection there. And frankly, even new construction's not perfect, because when I sell new construction, and I sell it every year, I have my clients get an inspection and we still find things.
Sure. But I think maybe to highlight, flexibility in this process is absolutely critical for moving from a potential home owner to a homeowner, and having, the understanding that things will change, and they may not change immediately, but they can change over time as you mature as a homeowner.
Right. So you might want to prioritize, your wants and needs, and some of them you'll get and some of them that won't. And then maybe at the bottom of your list, put something you're not willing to compromise on. Like if you must have a garage, or you must have 2 full baths instead of 1 bath, that type.
And to that point of flexibility, in terms of properties that you're going to view, it's important to have that flexibility with your financing, because just like as you mature as a homeowner, right, cultivating how you had the house to fit your your lifestyle, both your financial lifestyle and your living lifestyle, you want to have that same flexibility with your products and your programs and your mortgage financing. And the best way I can convey that to you is through my personal financing. So I've been in this house since December 2006. So 14 years. And the reason why that number is important is you're gonna find that number to be fascinating in a second. So for 14 years, I have always had ARMs, adjustable rate mortgages. Always had them. Most people, you say ARM, first time home buyers, you're likely not gonna take an ARM.
They used to be scary, but now they're more, reasonable.
Most people, if they take the time to understand them, and I'll show you how to do that in momentarily, you'll find it to be a tool. And that's why, I'm in the industry 19 years. So this is what I do for a living. I've always used it as a tool. So for example, I've taken 5/1 ARMs because it's allowed me to, you wouldn't do it today based on today's interest rate market. You wouldn't take an ARM. Very likely you wouldn't. You might, depending on the day, but let me highlight this here. So traditionally, when you take a 5/1 ARM, it gives you the lowest interest rate fixed for a 5-year period.
Right.
And the reason I found that attractive, and we have always used that product for all of our properties, is because, again, let's go back to that preparation and honest conversation you have with yourself. I could secure a lower interest rate fixed for 5 years. And what I chose to do through self-discipline is take the difference that I would have paid at a higher interest rate, but because I had a lower interest rate, I'm paying less in interest, and I would take that difference and I would apply it toward my principal of my loan.
That's really smart.
To pay my loan down
really
faster.
Smart, and very few people do that. It's amazing.
It's planning, right? It's preparation.
Really good.
And so what that allowed me to do was to pay my principal down faster.
Yeah,
so that lets me pay my principal down faster. I pay less interest over time. If there were months where I didn't want to pay my principal down faster, I could elect not to, right? I could create a capital account. I could create an account to pay for my taxes.
Right.
It was a tool for me.
Yeah.
Now, over time, based on our lifestyle and based on our cash flow needs, most recently I switched to a 15-year fixed product because I'm 41 at this point.
Right.
My girls are 10 and 12, right? I'm maturing not only as a homeowner, I've matured now as a borrower.
Right.
And now based on interest rates and things in our personal life, we elected to go with a 15-year fixed loan and take that payment and accelerate it depending on the pay periods, right? Because my wife and I earn our income with quarterly bonuses, so that we take those quarterly bonuses and then can apply that toward principal only.
That's great.
And I can elect to pay my loan down faster or slower at my election, my power.
Yeah,
right?
that's fantastic.
Good. So the reason that's important to understand being flexible going into not only what type of property you buy, but what type of financing is because over time, your lifestyle is going to change, your needs are going to change. And so though you may choose a product and program at the onset of home ownership, as you mature throughout your life or as you experience life events or life changes, you may change that product.
Right.
And so what happens is, as you go through this process initially, your loan officer will review all types of programs with you, whether they be conventional, whether they be FHA, VA, USDA, a construction loan, if you're building a property. They'll review all the available options with you.
Absolutely. And get you the best one.
Right. We'll go over those nuances. But bear in mind,
that's more than most people.
Right.
It used to be that the mortgage companies had more programs than the credit unions, but ABCO has more programs than any mortgage company that I know of.
Right.
And particularly portfolio.
Absolutely. Keep in mind that flexibility allows you to evolve and your financing to evolve. So you may at some point in your time as a homeowner, switch your loan, which, refinance your loan or change the type of term or product that you have.
Right.
To kind of drive, to drive that point home, the evolution of your financing as you move through stages of your life, you're going to want to, keep that mindset of be flexible, because the reality is that if you take a 30-year fixed loan, Bonnie, have you ever heard of, do you think most people keep that loan for 30 years?
Absolutely not. I don't know anyone much who did, except maybe our parents.
Yeah, typically the average life of a 30-year loan is 5 or 6 years.
Right.
The reason being is you're paying that loan down, your life is changing, and so you're likely going to, because of those changes, look at your financing and make adjustments. That might be to borrow more money for other expenses. It might be in our case most recently to say, okay, our girls are 10 and 12 and we want to be able to be flexible with where our next move is and want to pay our loan off in 10 years. How do we do that best? So that you're always planning as a homeowner. It doesn't stop just because you got the keys to the house. That doesn't stop.
Right. It's like everybody sees on TV, reevaluate your car insurance all the time. If your credit score is improved, you might qualify for lower car insurance.
Exactly.
Course.
So there's
it's the same thing with your house loan.
You're consistently evaluating.
You want to keep abreast of it, check into it once a year, and you can always call the lender or myself, and we can assist you in doing that.
Exactly. So you're constantly evaluating, number one, where you are, financially, where you are, lifestyle, where your lifestyle is, what your immediate goals are, what your future goals are. So it's important to be flexible in this process, not only in what you're buying, how you're buying, and what your needs might be as time moves on. And so we'll briefly touch on some of the details of the individual products. Your loan officer, after you've done your preparation and looked at your major mortgage application, will review those products more in depth with you. And you may find as you move throughout this process, depending on which type of property you buy, you may switch products. But rest assured that even though you elect a choice today, your lifestyle may change in the future, your goals may change in the future, and ABCO will be able to help you in the future when those changes do occur, because they will. I mean, the reality is you're not going to keep the loan for 30 years.
Exactly.
It's a much shorter period of time. So we'll briefly touch on some of the products to talk about the differences in down payments. Government loans, most popular government loan would be an FHA loan. FHA loans allow the maximum seller's assist, which is the maximum amount a seller can contribute to you becoming a homeowner at the maximum amount borrowed. So for example, if you put a minimum of 3.5% down, a seller can contribute up to 6% of the sales price to you becoming a homeowner. Bonnie, could you elaborate on how a seller's assist work and how common they are?
It's pretty common with FHA. There's usually some degree of seller financing. I don't see too much of the 6, but it certainly can be done, and I can certainly do that if needed. But what we usually do is I talk to the buyers, establishing how much money they have. And then once their down payment is covered, then we discuss how much of the closing costs they have, how much they might need to, make their move in. And then they tell me if they want to ask the seller for a contribution to that closing cost, and we negotiate it at the time of the offer stage.
And the worst thing that the seller could say is what?
No. And then you can always still ask for a contribution, but a little less. There's degrees of that 6% that we usually negotiate.
Good. One of the reasons an FHA loan is chosen for a lot of first-time home buyers is it's one of the only products that allows for a non-occupying co-borrower. So I think co-signer. But your loan officer, based on the individual conversation you have with him or her, will be able to go over the program in more depth and see if that's something that's viable, desired. But again, your product and program evolves as you move throughout the process.
Right.
So, a lot of times someone will say, well, I want to apply for an FHA loan. Well, why? Right?
You might do better with conventional.
You might do better with conventional. Your individual situation will vary. After home buying seminars, when they're in person, traditionally there's a line after for more personal questions, and someone will say, well, what loan do you recommend for me? I mean, the reality is I have to have at least a 5-10 minute conversation with you to really dig down and say, okay, this is where my brain is. Here's what I'm thinking. And then after I see, some documentation, your preparation, my answer might change, right? It's not just like a flip of a switch.
Now we have a question from Jasmine Brown about seller concession. A seller concession means that, let's just take 100,000 for round number, so it's very simple. Let's say the house is 100,000. Let's say the house is 110. Let's say you're offering 100,000. You're putting 3.5% down, which is $3,500. And then you're going to need a certain percentage of closing cost. The seller can contribute up to $6,000 toward your closing costs. That's considered a seller concession. Yes, FHA, it's not exactly that they have a charge for mortgage insurance, Karen. It's that anytime you put less than 20% down, there's like an extra risk insurance for that difference. And on an FHA loan, it's the MIP, which is the mortgage insurance premium. Okay, so it's not really a charge. You have to pay that because of the risk involved in putting less than 20% down, because ideally people should have 20% down, but it's a wonderful thing that you don't have to anymore. You can put 3.5% down, and that's what the extra MIP charge is on an FHA loan.
Good. So FHA is definitely a very common loan. It is the most popular government loan.
99% for first-time buyers.
Yeah, very well used loan for first-time home buyers. Mortgage insurance in the FHA world does not go away. So often what will happen is you may use an FHA loan initially, and then over time, as you mature as a homeowner, either having your equity increase by paying your loan down and property value going up, you might refinance to a different loan to negate or avoid having your mortgage insurance. So it's a great loan. Again, you'll make comparisons with some other loans, but you'll do that as you matriculate through the process. VA loans, second most popular government loan. You do have to be a veteran to use a VA loan. It's one of two programs that allows for 100% financing. A lot of times when people hear 100% financing, what they hear is they don't need any money. The reality is you'll still need money for closing costs and setting up an escrow account, so you do need some money. The mortgage insurance is priced into the loan. Difference in documentation from some of the things we talked about earlier is you would need to show that you qualify for the loan with the ED 214. So just a slightly different additional documentation.
Right. Now I see Tanisha's asking about the first-time home buyer grant. The answer to that is, can I use that with ABCO Credit Union loan process? The answer is yes,
Absolutely.
yes, and yes.
Absolutely. I've yet to see a grant program that we haven't been able to work with.
Now,
any type of grant program.
I just want to caution them that grant, it's a bond and it does run out. So if you're interested in using it, you need to get in on it right away, because now that after COVID, we're starting to open up a little bit after being shut down, we're getting really busy with it.
Yeah.
So if you are thinking about buying a house seriously at this time in the next quarter, maybe, give us a call and talk to us. There'll be no pressure. Nobody's going to strong arm you or anything like that. We're just going to give you useful information to help you plan for what you're going to do.
A lot of strong grant programs out there for sure. But again, I've yet to see one we haven't been able to work with.
There's also a county grant.
Yeah,
So, that's a good thing too.
Yeah.
Now, when you use the state grant, you have to stay in the house for 5 years. If you sell the house within that 5-year period, you have to pay it back. And it is $10,000. It's a lot of money. Okay, so if any of you are considering it, please contact us so we can see if you qualify for it.
Good. Yeah, great grant programs out there. Definitely can be the difference in between.
It's an amazing thing.
Becoming a homeowner or not.
It can make you a homeowner when you otherwise wouldn't be.
Yeah, good stuff. USDA second loan that allows for 100% financing. One of the nuances of this type of loan is that the property itself has to be within a USDA region. There's a quick check on that. You just need a property address. Is a great loan program if you're looking to get into a property with as little out of pocket as possible. Traditionally, government loan programs have a minimum credit score, which would be roughly 620. Now, if you don't have that score today, that's okay. Still want you to make application. We'll work with you to help you, improve your credit. There's a number of things that you can do. Sometimes, the answer is you have to have time away from some negative credit, but we will show you some steps to take in the meantime in order to continue to move toward home ownership.
Another question there from Karen. What if you were left a home and you took a second mortgage to do renovations? Would you still be considered a first-time buyer or not? Well, is your name on the deed? I mean, that one's a little bit complicated. We might need to talk to you afterward about that. But there's definite guidelines for the grant, and you usually can't own any other home. But if you took out a personal loan to do the renovations, or something like that, that might be different. So it's a little bit complicated. So you might want to contact us by email or phone call.
Yeah, the answer would be typically a first mortgage program does not hinge on the fact that you haven't owned a home before. It would be the grant program that you may or may not qualify,
right,
based on owning a home within a set period of time. And again,
right.
each individual,
it doesn't matter.
Yeah, each individual grant program would have its unique set of guidelines for that. But to kind of answer the question, if you were looking to take money out to fix the property up, it wouldn't hinge on the qualification of you being defined as a first-time home buyer.
And also, Tiffany's asking if ABCO can loan outside the tri-state.
Yes. Yes. So there's many states that ABCO can loan in at roughly 43.
And if you need an agent in that state, you can let me know and I can help you get one.
Good. Now, these are the government loan programs. Again, when you work with your loan officer, they'll go over the individual programs that apply to your situation. The most popular loan that is used to finance a property would be your conventional loan, which is going to require a minimum down payment of 5%. And there are structures where you would have mortgage insurance or you may not have mortgage insurance. So there's multiple options there. At maximum financing in a conventional loan, a seller can contribute up to 3% seller's assist, which can offset some of the costs that you would pay traditionally in the process. But you do not need to have 20% down. Again, in the credit union world, most the average down payment is around 4 or 5%. So it's certainly not 20%. I've gotten that question a lot of times.
My first-time buyers are 3.5% down.
At home buying seminars, I want to buy a house, but I don't have 20% down. And It's fantastic. You don't need 20% down. You know, I didn't buy a house with 20% down. I would say, you know, doing this almost 20 years for purchases, I can tell you it's probably less than 10 times I've had someone put 20% down. People just don't do it.
Sierra's asking about the conventional loan. Okay, so a conventional loan can actually be less than 20% down. Also, she said, is there a slide for conventional? Do you have a slide for conventional?
We don't have a slide for conventional, but I can send you conventional guidelines. So Sarah, I'll create a slide for you. The other type of loan is more in-house loans, a portfolio loan, and that's where APCO will look at your individual situation. They don't have to look at a canned set of guidelines, and they can say, okay, based on, you know, this member's individual situation, we can write a loan to them, which to me puts APCO head and shoulders above, you know, all of your traditional lenders out there and your larger lenders out there.
And we also have another question. What's the credit score needed for VA? And of course, VA, you need no down payment. So that's 100% financing.
So your government loans, you're going to, any government loans, you're going to need a minimum credit score of 620. So VA would be within the government loan programs.
Now that's, you know, you have 3 scores in your credit. I'm sure everybody knows that by now, I think. You know, there's 3 repositories: Equifax, TransUnion, and Experian. And when you check, like with some of these sites like Credit Karma, they only give you 1 credit score. So the lender has to look at all 3 of those scores. The 620 has to be the lowest one, right?
But what I would say though is don't let your credit score deter you from applying, given that there are compensating factors in the credit union world that will, you know, may allow you to move forward at this time, or at the very least, your loan officer will work with you to put together a plan so that you can exceed that minimum credit score and
Right.
move forward.
Some of my clients have done the Experian Boost.
Yeah.
And they got a boost, you know, of 10 to 20 points on their credit.
So I told you earlier, I'm a stats man.
Yeah.
We see roughly 2,000 applications a month right now. 2,000 applications a month right now. Bonnie, what percentage of those applications do you think cannot move forward at the point of application? Meaning they can't move forward. If they apply today, they can't move forward tomorrow without some work. What percentage do you think it is?
Well, is this before or after they speak to the loan officer?
This is before they speak to the loan officer.
I would say probably less than 5%.
35% cannot. It's true.
Wow.
35% can't move forward at the time of application. It's just the way it works.
They didn't do their homework.
What do you think we do? We say to those 700 people, we're done with you. No, we don't want to talk to you. No, we're a credit union. So we work with those 700 people to put a plan together. Now let's get real. Let's have a real
by contacting you, because now they know what to do.
Well, let's have a real conversation here.
Yeah.
And I'm going to get right down to it. So of those 700 people, okay, so 1,300 can move forward. Of those 700, we will take the time to outline a plan with them so that they can have a tangible path forward, right? That might have to do with budget. That might have to do with, you know, correcting some credit scores or moving past some negative events, right? We'll give the member that information, but it's up to the member to then apply that information to move forward.
That's so amazing. That's so amazing. You know, so many, I remember when the lenders didn't do that for you. Okay.
This is a really good thing.
It's about the honesty thing. Like you said, you have to face these things because you're never going to get ahead in life if you don't.
But for the member, from the member perspective, that gives them power, right? Because a lot of times when somebody can't move forward today, it's discouraging. I got it.
Totally.
That's okay. We'll give you that information so that you can move forward. And so after we finish up, most people right now, I can tell you there are, about 25 people right now on the call. If we were in person and I asked that question, show of hands, budget, I can tell you it's less than 10% raised their hand. So let's just call it 3. So there's another 20 people that need to do a budget, right? And we'll work with you individually to create that budget, because that's going to lay the foundation.
I don't think people realize that's like one of the best things you can do in your whole life. That opportunity to talk to someone as knowledgeable as you.
It lays the foundation.
Amazing.
For, okay, though the preparation takes 30 minutes and the process takes 30, 60, 90 days, it's the preparation for the next 30 years if you're in the house that long.
You're not kidding. You're going to look back on it and say, boy, am I glad I called ABCO and got this information. It started my whole financial life in a positive way.
Well, that's just it, right? It's not just applicable to home ownership. Some of you will leave tonight and say, you know what, this is not what I want to do right now. But I can tell you, if you go home, put that pen on paper and do that budget, you're going to improve your financial life one way or another.
Totally.
So it's definitely something to consider.
Seed of different thinking, you know, and then the thinking process is improved. You know, every time you learn something good and positive in your life, your thinking process improves.
Exactly. And ABCO is going to give you that, you know, when you are ready to move forward and you've done that prep work, they have every program that is available. And again, they have those portfolio programs. And so what we've done tonight in a very short period of time is we've given you a lot of information. You're going to have some questions now that you might want to ask in front of the group. If the questions are more personal in nature, Barbara's going to send out our individual contact information. I'll have my cell phone, I'll have Bonnie's cell phone. You know, feel free to give us a call. I've been in, you know, hundreds of these seminars at this point over 20 years. You can give me a call, ask me to run through your individual scenario. There isn't a scenario I haven't seen.
And I think Barbara's saying we've probably gone over pretty much what we can as a recap. And then should we go ahead and ask if anybody has any other questions right now?
Right. If there are questions you feel comfortable asking in front of the group, certainly do so.
Well, I think we're good. So Patrick and Bonnie, I want to thank you both again. It's always fun listening to you. You guys both have a lot of knowledge. And thank you to all who participated in this meeting. I look forward to connecting regarding this information and on future seminars. So everybody, good luck in the home buying process, and have a great
Good night.
Great job, Barbara. Great job, Bonnie. Thank you.
Great job, Patrick. Barbara, great job.
Bye-bye.
Take care.
Bye.